How did a humble immigrant go from managing $200 million to secretly controlling over $100 billion in stock positions, only to lose it all in just 48 hours, taking down multiple global banks in the process? Bill Hwang's rise and fall is one of the most spectacular financial disasters in modern history. This is a journey through the dark side of Wall Street. From hedge fund billions, to insider trading scandals, to a secret comeback that shocked the financial world. Welcome to the insane story of Bill Hwang and the Archegos collapse. The American Dream. Born Soon Kook Hwang in South Korea in 1964, Bill grew up modestly with his pastor father. As a teenager, his family immigrated to the United States, settling in New Jersey where his parents worked multiple jobs to make ends meet. Bill had an intense work ethic and believed education was his path to success. He threw himself into his studies, earning his way into UCLA for economics, then an MBA from Carnegie Mellon's prestigious business school in 1988. Armed with his degree and burning ambition, Bill headed straight for Wall Street. The Tiger Cup years. In 1990, Bill landed his first job at Hyundai Securities in New York, analyzing Korean stocks for American investors. The work was tedious, but Bill had a gift, an almost supernatural ability to identify undervalued stocks. His talent caught attention. In 1996, he was recruited by Tiger Management, one of the most prestigious hedge funds in the world, run by legendary investor Julian Robertson. Bill became a quote-unquote Tiger Cub, one of Robertson's personally mentored protégés. Quote, Julian Robertson taught me everything I know about investing. He showed me how to think differently about markets. End quote. For 5 years, Bill worked his way up, eventually heading their Asia trading desk and managing hundreds of millions of dollars. Robertson taught him advanced strategies, risk management, and most importantly, how to use leverage to amplify returns. When Tiger Management shut down in 2000 after the dot-com crash, Robertson offered Bill something extraordinary: seed capital to start his own hedge fund. Tiger Asia's rise. In 2001, Bill Hwang launched Tiger Asia Management with $25 million from Julian Robertson. His strategy was brilliantly simple: identify undervalued Asian companies, take massive concentrated positions using leverage, and wait for the market to catch up. The results were spectacular. Tiger Asia returned over 40% in its first year. Money poured in. By 2007, Bill was managing $3 billion, generating annual returns often exceeding 30%. Bill moved to a sleek Manhattan office, hired top analysts, and started living the dream. Expensive cars, luxury homes, private jets. But more importantly to the deeply religious Bill, he gave away massive amounts to Christian causes through his Grace and Mercy Foundation. To the outside world, Bill Hwang was the complete package. Brilliant investor, generous philanthropist, family man, devout Christian. However, beneath the surface, Bill was crossing dangerous lines. The insider trading scandal. By 2008, Tiger Asia managed $5 billion. But Bill's thirst for information had become problematic. In 2008, Bill received a tip from a banker friend at a Chinese state-owned bank about a planned stock offering that would dilute shares and crash the price. Bill immediately shorted the stock. Tiger Asia made over $16 million on the trade. It was textbook insider trading. Hong Kong regulators charged Tiger Asia in 2012. The SEC followed. Rather than fight and risk prison time, Bill settled in December 2012. Tiger Asia pleaded guilty to wire fraud and paid $60 million in fines. Bill was banned from managing money for outside investors and had to shut down Tiger Asia completely. After more than a decade building a multi-billion-dollar powerhouse, it was over. Most people would have retired. Bill had made hundreds of millions personally and been publicly humiliated. But Bill Hwang wasn't done. He was about to make the most audacious comeback in Wall Street history. The family office loophole. In early 2013, Bill still had something crucial. His own personal fortune of $500 million to $1 billion. And nothing in his settlement prevented him from investing his own money. Bill started a family office, a private investment firm managing only his wealth. He called it Archegos Capital Management. The word Archegos, pronounced Arch-egos, is ancient Greek meaning, quote, one who goes first or the leader. But Bill didn't just want to rebuild his wealth. He wanted to multiply it beyond anything he'd achieved before. His weapon? Total return swaps. Here's how it worked. Instead of buying stocks directly, Bill would enter swap agreements with major banks like Goldman Sachs, Morgan Stanley, Credit Suisse, and Nomura. The banks would buy the stock, but Bill would get all the economic benefits or losses. This was brilliant for two reasons. First, because the banks technically owned the stock, Bill's positions were completely hidden from public view. Nobody knew what stocks Archegos controlled or how large those positions were. Second, the banks gave Bill massive leverage. 5 to 1, 6 to 1, sometimes 8 to 1 or higher. Bill's $500 million could control $4 billion worth of stock. But here's the truly insane part. Bill was doing this with multiple banks simultaneously. Goldman Sachs thought they were his only bank. Morgan Stanley thought they were his only bank. Credit Suisse, Nomura, UBS, they all thought they had the full picture. But they didn't. Bill was operating in the shadows, building a financial empire nobody could see. The secret comeback. Between 2013 and 2020, while Wall Street had written off Bill Hwang, he was quietly building one of the largest investment portfolios in the world. Bill's strategy was even more concentrated than before. He'd identify 10 to 15 companies, mostly media and technology stocks like Viacom-CBS, Discovery, Baidu, Tencent Music, and take absolutely massive positions using his swap agreements. The strategy worked spectacularly. In 2019, Archegos returned 60%. In 2020, during the pandemic, it returned over 120%. If Bill started 2013 with $500 million, by early 2021, his personal fortune had grown to somewhere between $10 billion and $20 billion. But because of his leverage, Archegos was controlling between $100 billion and $160 billion in total stock positions. Think about that. A family office most people had never heard of, run by a disgraced former hedge fund manager, was controlling more stock than some of the largest institutional investors in the world. The banks were happy collecting massive fees. Bill was getting richer by the day. His stocks kept going up. But Bill's positions had become so large that he effectively owned huge percentages of these companies. If anything went wrong, if these stocks started falling, he'd face margin calls. And because he was so heavily leveraged, even a small drop would require massive amounts of additional cash. Throughout 2020 and into early 2021, this seemed theoretical. Then, in March 2021, everything fell apart. The 48-hour collapse. March 22nd, 2021 started normally. But that afternoon, Viacom-CBS, one of Bill's largest holdings, announced it would issue $3 billion in new shares to raise capital. This was a nightmare. New shares meant dilution, which would cause the stock price to drop. And Archegos controlled an estimated 20 to 25% of all Viacom-CBS shares through various banks. Tuesday, March 23rd, Viacom-CBS stock fell from $95 to $75, a 20% drop in one day. For a normal investor, painful but manageable. But Bill was leveraged 5 to 1 or more. This essentially wiped out his entire equity position in Viacom-CBS. Other stocks in Bill's portfolio started falling too. That evening, the phone call started. Goldman Sachs, Morgan Stanley, Credit Suisse, Nomura, UBS all saying the same thing. You have a margin call. Deposit more cash immediately or we'll liquidate your positions. They'll try to calm them down, but here's the problem. Each bank was now discovering that Bill had similar massive positions with other banks. His total exposure was far larger than any single bank had understood. If one bank started selling, it would drive prices down further, triggering margin calls at other banks, who would then also start selling. It was a doomsday scenario happening in real time. By Thursday, March 25th, the banks were done waiting. Goldman Sachs made the first move, dumping huge blocks of Viacom CBS, Discovery, and other stocks onto the market. When Morgan Stanley saw Goldman selling, they panicked and started selling too. Then Credit Suisse, then Nomura, then UBS. It was a feeding frenzy. Trading floors were in complete chaos. Viacom CBS, which had been at $95 days before, was now trading around $45, half its value in less than a week. Discovery fell from $75 to $35. By Friday, March 26th, Archaic's capital management was finished. Bill's entire fortune, estimated at $10 to $20 billion just days before, was completely wiped out, gone, evaporated in less than 48 hours. But the damage didn't stop with Bill. Credit Suisse lost $5.5 billion. Nomura lost $2.9 billion. UBS lost close to $1 billion. In total, the Archegos collapse resulted in more than $10 billion in losses across the global banking system. Criminal charges in trial. In April 2022, federal prosecutors in New York criminally charged Bill Hwang and his top lieutenant with fraud, racketeering, and market manipulation. The indictment alleged Bill had systematically deceived banks and manipulated stock prices. Prosecutors had emails and recorded calls showing Bill had misled banking partners about his total exposure. Quote, Hwang and his co-conspirator manipulated the market on a scale unprecedented in the modern era. End quote. If convicted on all counts, Bill faced the possibility of spending the rest of his life in prison. Bill maintained his innocence, arguing he'd simply made aggressive investment decisions that didn't work out. But the evidence was damning. In May 2024, after a lengthy trial, a jury delivered its verdict. Bill Hwang was found guilty on 10 of 11 criminal counts. He faced up to 20 years on each count, meaning he could potentially spend the rest of his life behind bars. The aftermath. Credit Suisse, as massive losses from Archegos were one of several scandals that contributed to the bank's eventual collapse and forced merger with UBS in 2023. The bank that survived 2 world wars was partly brought down by Archegos. Regulators began implementing new rules requiring more transparency around total return swaps and better risk management at banks. Lessons from the collapse. The Archegos story reveals crucial lessons about modern finance. First, the power and danger of leverage. Bill's strategy only worked while markets went up. The leverage that multiplied his gains multiplied his losses even faster on the way down. It's like climbing a mountain with a rocket strapped to your back. You'll get to the top faster, but fall much harder. Second, systemic risk assessment failures. Goldman Sachs, Morgan Stanley, Credit Suisse, supposedly the smartest institutions in the world, failed to ask one simple question. Is this client using similar leverage with other banks? Each bank thought they had the full picture, but they were all looking at just one piece of the puzzle. Third, dangerous complexity. The financial system has become so complex that even the biggest players don't fully understand it. Total return swaps and synthetic positions were designed to help manage risk, but in Bill's hands became weapons of mass financial destruction. Fourth, the human element. Bill wasn't a reckless gambler. By all accounts, he was deeply religious, generous, and hardworking. He gave away hundreds of millions to charity. But he had a fatal flaw: hubris. After his insider trading scandal, Bill could have walked away with hundreds of millions and lived comfortably. Instead, he needed to prove he was still the brilliant investor he believed himself to be. And in pursuing that validation, he took risks no rational person should take. The story also raises unanswered questions. Should it be possible for one person to secretly control $100 billion in stock positions? Should banks extend that much leverage to a single client? Should family offices be exempt from reporting requirements that hedge funds face? While regulators have proposed new rules, the basic structure that allowed Archegos to happen still exists. Someone else with enough capital, leverage, and ambition could potentially repeat Bill's strategy. The tragic arc. Looking back, Bill Hwang's story is Shakespearean in its tragic arc. He had everything needed to live a comfortable, successful life. Instead, driven by ambition, faith in his own abilities, and a desire to prove critics wrong, he reached for more and lost it all. The immigrant boy who dreamed of Wall Street success achieved it beyond most people's imagination. Twice. But both times, he pushed too far, took too many risks, and paid the ultimate price. The Archegos collapse teaches us that in finance, as in life, gravity always wins eventually. You can fly high on leverage and ambition, building wealth beyond imagination. But the higher you fly without a safety net, the more devastating the fall when it inevitably comes. Bill Hwang learned this lesson the hardest way possible. His story is a reminder that in the pursuit of wealth and success, the most dangerous risk isn't losing money. It's losing perspective on what's truly at stake. And that's how Bill Hwang built a $100 billion portfolio and lost it all in 48 hours, taking multiple banks down with him and ending up convicted and facing life in prison. It's a story of ambition, genius, hubris, and ultimately, a catastrophic fall from grace that shocked the entire financial world.